All right, everyone. Well, we'll go ahead and get started. So, I am super excited to have Mo Al Adham with us today. Um, and Mo is like just really awesome and cool in what he's been able to do. And what we're going to be talking about specifically here is his newest company called Frec, which specifically focuses on direct indexing, which is something we've talked about on the site and kind of the main issue with direct indexing has really kind of been access to, just regular investors. And Mo has really kind of developed a solution to that and sort of positioned Freck as like the vanguard or like, the Jack Bogle of direct indexing, which is really cool. And I'm also excited to have him here. And a lot of us are interested in just, side gigs as a physician or kind of building up an entrepreneurial network. And Mo has an incredible story. I mean, he's created and sold companies to Twitter. He worked at Twitter for a number of years, was, I believe, the first advisor with Instacart. So just really involved with some incredible companies and doing it with Freck as well. And so I'm really honored, Mo, to have you here talking to us number one, just about your journey and as well as what you've built with Freck and how that can really help physician investors. And so, yeah, I'll kind of get started, I guess, just by asking you, Mo, if you don't mind sharing a little of your background and kind of how you got into all of this.
Yeah, absolutely. And I appreciate you having me here. So I started out my career as an entrepreneur. I built a company. We ended up exiting that company and to Twitter. And then in the process of doing that, of building that company in 2007, Bay Area, San Francisco was still sort of like not the place to be for entrepreneurs. It was mostly Silicon Valley, but we were young at the time, 2007, and so we wanted to live in a city and so there's a small cluster of us building companies. Like my neighbor was a Dropbox founder, the file sharing app, and we used to hang out all the time. And then, my roommates have all gone out to do s- different things. Avlock, one of my roommates, is now the CEO of AngelList. If you do angel investments through AngelList, Avlock is the CEO. And one of the people in that network was the founder of Instacart, Apurva Mehta. And so I met him there in San Francisco at the time, 2008, and helped him get started because my company at the time was venture funded. So we had raised about $12 million to do this video app that allowed celebrities to share videos on Twitter. Back then, Twitter was the AI of today. Today you hear about AI and all these startups doing AI. Back then, it was Twitter and social media and democratizing, blah blah blah, access to to news, right? And video was like a big thing back then. And so we built the video app for Twitter, and we raised venture capital. And I was one of the Waterloo. I went to school in Waterloo in Canada, so I'm Canadian, immigrated here in 2007, and so there's a big network of tech people that were coming in from Waterloo to raise money to build companies, and Apurva was one of those people. So I helped him found Instacart. I was the first advisor of the company. I sort of like helped him put together the round, the seed deck, and pitch investors and close funding. And that company ended up flourishing, right? Did very well. And so you can sort of like think of me as like maybe an early employee at a very successful company. I wasn't an employee, I was just an advisor, but I had a little stake in the company. And when it went public, I was too concentrated, right, in Instacart stock. Everything else paled in comparison to the Instacart kind of portion. I didn't want to have that concentration risk. So I started selling stock to diversify. And lo and behold, I learned that there's a way to minimize taxes quite a bit on selling assets with gains to diversify them. And we all may do this in different shapes and forms, right? You may want to be buying a house, but then you have some other, maybe you sold your clinic and you have like I don't know, some gains, or you maybe have you're selling another house that has a lot of gains and you're buying another one, or a stock, or something like that. Anytime you sell something at a gain, there are ways to offset those gains, and it could be very material, especially if you're living in a high tax state, like I do in California, or maybe in the East Coast in New York and so on. So I stumbled upon this sort of idea of direct indexing, and it was pitched to me by an advisor. I just had zero trust in them, right? I was like, well, how much does it cost? Like, okay, it costs 45 bips. It was a company called Just Invest that Vanguard had just acquired actually. And they were offering direct indexing for 45 bips. And I was like, well, if I'm doing the math correctly, that's 42 bips more expensive than VOO. So why am I paying this whole, like, can you justify this? Is the premium justifiable? Yes, I want to save money on taxes, but am I going to be paying a 42 bips premium forever relative to VOO for good? Because then I got to do the math on like the 30 or 40 years that I have left to live and paying an extra 42 bips plus your fees as an advisor to save a little bit of money on taxes now. So that didn't make sense for me.
Yeah, I think that.
Everyone,
Oh,
an advisor. Yeah. Sorry, Lauren. Go ahead.
oh, sorry. No, I think that was my fault. It cut out a little on my end, but no, no, keep going.
Uh, no, no, that basically that was the point. Is like save money on advisory fees, and also the service itself should be at a reasonable sort of like price point where it makes sense.
Yeah, and I think that's so cool because it is, I mean, the concept of direct indexing, which I know you'll talk about, makes a lot of sense, but it's not something as a single investor alone you can necessarily really feasibly do just because of the time it takes and also the fractional shares you need to own and things like that. And so I'm like so excited to hear, the nuts and bolts of this and kind of how Frec has democratized this. So yeah, I'll let you jump into it, but I'm excited.
Yeah, great. Awesome. And if there's anyone in the audience that wants to like throw a question in the meantime or even interrupt, we can do this as an interactive session. So
Absolutely.
no worries at all if something comes up. Okay, so so I'm gonna walk through that same learnings that us as a company. So we're a venture-backed company as well. I raised $26 million from Greylock, big VC. They funded the very early investors in like LinkedIn and Facebook and and so when like when we were raising money for this company, we had to make the case for the investors as to why this is a viable standalone company. And we had to convince ourselves, hey, we're going to leave all these like high paying jobs to do this. Is this worth it? Is there real value? And so I'm going to walk you through the same process that we walked through ourselves to understand this from the ground up. And then I'm going to sort of like articulate the tax advantage and why the price point is an important factor. At the very basics, we started sort of like trying to understand from first principles. Direct indexing is an evolution of investing, right? What started out as mutual funds back in the 70s became ETFs. ETFs had a massive advantage against mutual funds, right? With mutual funds, you had to pay your taxes every year. Whenever you had a gain, if the market was up 10%, you get passed down the 10%, and the IRS is very happy with that, right? You're constantly sort of like staying current on your tax bill. And when you sell at the end, it's not a big hit, right? It's like a small hit because you've stayed current so far. Those are sort of like the taxable in a taxable account, right? That's how it used to work until ETFs came along. And with an ETF, you delayed paying your taxes until the end. You bought something and then you hold it, no tax for years. And then when you sell it, that's when you sort of like pay the tax, right? So, and direct indexing takes that a step further. So not only are you not paying taxes during the whole period, but in fact, during the whole period, you're accumulating capital losses, right? It's sort of like put puts it on steroids, right? It pauses the taxes while you're holding, and it gives you tax losses. And then the side benefit of it is you can also personalize your index. So you can say, well, I want the S&P 500, but I work at Meta, so I don't want to double dip into Meta, so I'm going to actually exclude Meta, or I have already a lot of Nvidia from an early bet, and I don't want to buy more Nvidia, etc. So you can personalize, which is very nice. Okay, so what is direct indexing then? It's a tax deferral strategy. This is a group of very smart people, and so nothing comes for free, right? It's not like the taxes just evaporate; they're deferred into the future. And sort of like anyone that tells you they're going to eliminate taxes for you is lying to you, right? There's no elimination. There's deferral, and you defer it, you kick that can down the road, and sort of like, and what does that do? It's like an interest-free loan from the IRS, right? You're taking advantage of that capital, where you're compounding and investing and growing that capital until you have to pay that tax bill in 10 years. So this on the right is a chart from Goldman Sachs that shows the benefit of investing in an ETF over a mutual fund, which remember that is also an interest-free loan from the IRS, right? And there's a cumulative benefit of 4% over 10 years, right? Um, and so, and by the way, there's a the unspoken thing. The unspoken rule is that that interest-free loan from the IRS is completely forgivable if you die, you know? And so, because there's a step up in cost basis, right? So, that's why deferring taxes is a good idea, is because there's that step up, the 24 million or 26 million dollar allowance on that estate side of things when at death, and yeah, defer taxes as much as possible. So how does direct indexing work then? What is the magic behind it? So I want to describe it mechanically a little bit, just to kind of get the concept across. So we're all familiar with ETFs. You probably all have bought via O, SPY, whatever. And so all of these ETFs, they track an index, right? They track the S&P 500 or the Russell 2000 or whatever. And so we go out and we license the same index, the S&P 500, and we know the target weights. We know that every night the S&P sends us the weights of every single constituent, right? And so we go in and we buy the S&P 500 constituents at their target weights. We buy Nvidia at 5%, and Apple and Microsoft and Exxon Mobil and so on and so forth, right? And and then we monitor it every day. And then anytime a stock, an individual stock loses, our optimizer makes a decision to sell or not. In most cases, it sells to harvest the loss. So in this case, it harvested the loss of that red block. It booked the $100 in loss, and it exchanged that money into another symbol that correlates with the thing we just sold, right? And I'll get to how we do the exact correlations and the math behind it and the tracking and all that. But it basically does this dance, right? And then it tracks the index really closely. And 30 days later, because of the IRS wash sale rule, we're able to, after 30 days, buy back the thing we just sold. And we do this over and over again across all the stocks at the tax lot level, right? So we do it across maybe potentially thousands of tax lots every day. We scan for opportunities, buy, sell, rebalance, get your losses. So at the end of the day, you're tracking the index really well, and we'll talk about the tracking and kind of the variables there, but very very closely, up plus or minus a maximum of 1%. A lot of our customers actually are in the plus; they're very happy, and a lot of them also are in the minus, and we have to explain. But it's like plus or minus. But your tax alpha, the losses that you're harvesting, make that risk worth it, in my opinion, at the right price point, right? And so you get the tax losses to offset your tax bill. Okay, so what does an account look like? A direct indexing account, at least on the way we've designed it on Frec, very sort of like product oriented company, right? Our company is a lot of designers and engineers that are sort of like our vision is to turn it into a very sort of like easy to use product, just as easy as an ETF. It shouldn't be any harder, right? So you buy that, you put in, there's a minimum. We have to buy the stocks, right? So we can't do it with $10, right? We have to buy the 500 stocks, and so it used to be that the minimums were high, like a million. Our minimums are $20,000, and that's because we need that much to buy stocks fractionally. But an account looks like this. You actually see the holdings, and owning the holdings is nice because you actually get the dividends when they're issued, right? With that, when you buy the ETF, the dividends are paid out once every 3 months. They're saved in a non-interest bearing account, and then they're paid to you every 3 months. But over here, you get the dividends in real time, right? As you own the stocks, you can vote the stocks, you can lend out the stocks and make money. And so there's other advantages to owning the stocks. And then, so you see them, right? You see them, you have exact values for each of them. You own these stocks, right? They're in your name. And then you get to see the way we've designed it on Frac, you get to see what your value of the index is relative to the ETF if you had bought the ETF, because that's our closest competitor, right? So you see, okay, well, if you had put the same $50,000 here, your SPY would have been 567,344, your 67237. So you're $100 off, right, from SPY over the course of a whole year. When I took the screenshot, a year and 4 months maybe, and then in exchange for that tracking error, you've harvested this much in losses, right? So let's do the math. You gave up $100 in gains, but you got $2,700 in losses, right? And this, by the way, this is a screenshot back from Feb 10th. This is before the big correction. So if you go to our Frec.com today, there's a section called Live Demo on top. How it works, live demo. You'll see an update of this after the correction. We've harvested a lot more losses since then, right? So there's a lot more loss, and you'll see the tracking as well. And so the big question that you may be asking yourselves is, how much am I going to harvest in losses, right? Is it just, is it a tiny bit? Is there juice worth a squeeze? And so this is Vanguard study that shows that, over the course of every dot is a 10-year sort of like period, right? So in the year 2002, you would have harvested for $1 million deposit, harvested $600,000, north of $600,000 in losses, right? In 2008, you harvested 800,000, big correction, right? But on average, you harvest, in any given sort of like, decade, about 40% of an investment in losses, right? So if you put in $1 million, you get $400,000. And this is a large cap index. So we support all caps, we support small caps, mid caps, and they harvest at different rates, right? And the numbers on the right are a 5-year period. So that's why they're a bit smaller. Um, and then the other property about the losses is they're front loaded, right? So you get most of the losses in the first few years, and then it kind of plateaus, and then every deposit kind of behaves in this way. So every deposit's got its own curve, and so the next deposit gets its own little curve. It's a misconception that if you deposit more, your direct index gets like replenished. Not really. The new tax lots that you're buying are behaving this way, right? It may look in aggregate that it's replenishing, but really the old tax lots are still doing this, right? And at this kind of cadence. Now I have to plug in that we're working at Frec on a product called long short direct indexing. We're very excited about this product. You'd be able to go like 130 long, 30 short, and this curve looks very different for a long short direct index. You can harvest 100% of your deposit in losses. $1 million gets you $1 million in losses. While tracking the index, there's a bit of a higher tracking error, plus or minus 1.5%, but close tracking error. And it doesn't behave this way. It kind of goes up and to the right. So it continues to produce losses for you. We can talk a bit about that in a minute. But uh, you know, it, if that product is interesting, this one's also interesting at a lower scale. If you need a lot in losses, then you can buy the long short. But if you need some modest losses, then the long only index is just good enough. And so one thing I kind of alluded to is like, why can we do this today is because of fractional shares, right? So we can buy now 7.889 of NVIDIA. So we can do that direct indexing for $20,000. A couple of years ago, you needed $1 million to do the direct index, right? And it's largely for that fractional shares ability, right? Um, cool. So this is sort of like my favorite section in the in the presentation because it kind of really puts this in perspective and makes it relatable for everyone. Like how does this benefit me? How much money am I going to save? And so what, right? Okay, losses. What do they mean? So there's two big use cases for direct indexing. The first one is I expect cap gains in my future, right? I have a house that I'm going to sell, or I have some stock that I bought and now it's very concentrated and there's a lot of gains in it. So if you have another pile of money that you're throwing into an ETF, into like the S&P 500, ETF, then you may as well, or VTR or something like that, you may as well put it into a direct index to generate losses so that you can offset the gains from selling those other positions, right? And this is a very classic way to use this. Actually, we meet a lot of employees who earn their living on cap gains. They get a K1 at the end of the year. They have short-term cap gains. That's how their salary comes in. And so if you put that salary into a direct index, then you're generating losses that you can offset, the gains from the K1. But it applies to everyone, right? If you're exiting an angel investment or whatever. And there's no limit to how much you can offset in cap losses in cap gains with cap losses. It's unlimited. You can offset $2 million in gains with $2 million in losses. And then the rest carries over. you carry it over to the following year until you die. You can't pass them along, unfortunately. They're not an asset like on a balance sheet that you can pass down, but they go away when you die. Um, and then, there's an extra $3,000. It's an and relationship. So you offset the gains and you get to offset an additional $3,000 of ordinary income if you have W-2 income. And so that's kind of the classic way to use it. Um, if you want to quantify the benefit of that, some people call that tax alpha, and they assume, okay, if you are using up all of your losses and every year and taking the tax savings and putting them back into the market, you're going to make 1.36 to 3.1% more. And this is a Vanguard kind of methodology. I'm not a big fan of this kind of way of thinking about it because I don't always have cap gains every year. But if you want a number that kind of puts it in perspective, this is the number. The second use case is, to me, more relevant to people because if you don't have cap gains outside of the core portfolio, and at some point you're saving money, you're planning to one day retire, you're putting money away into a diversified portfolio of index funds, and one day you're going to draw down from this index fund to live, maybe in retirement, right? So let me sort of like describe that in a model and imagine $1 million portfolio. You're going to invest it in 1 year, and you're going to start drawing it down by year five. Okay, so it's going to sit in the market compound for 5 years, and then you're going to take it down by year five. And let's imagine you doing this with an ETF versus a direct index, right? So the ETF case is simple. You put in the money, you're not paying taxes for the first 5 years because you're not drawing down on it, and then you start taking 10K a month out of your portfolio. It's growing, of course, 10% a year. So you'll see it's kind of your cumulative taxes are going up. And then by year 16, you sell everything. So you pay the rest of your tax bill, right? This is kind of simple. Direct index, what it does is in the first 5 years, like we said earlier, it is generating losses, right? It's sitting there just spitting out these losses. You get 1099Bs from your brokerage account with a loss, right? $80,000, $100,000. And they're just accumulating. So when you're starting to take money out of your portfolio by year six, right? You're not paying taxes, but you're chipping away at those losses that you accumulated, right? And then by year 13 is your first tax payment with a direct index. You've delayed taxes for 7 years as you're drawing down in your portfolio, right? And with an ETF, of course, the first tax payment is early on. So then you have to, sort of like at this point, it's like, okay, this is what have you done with the money in these 6 years? You've delayed taxes, you've compounded that tax payment for longer, right? And at the end, you pay the same amount of money, like the tax payments ramp up quicker with a direct index because you have to catch up faster, but you've delayed it, right? And then guess what? If not to sound morbid, but if you die over here, like, you do not pay any of the taxes, right? In the blue lines, right? You get the step up in cost basis. Yeah, so those are the two main use cases, and that's kind of how it works. Any questions so far on this section?
No, that was great, like illustration of kind of the benefits there. And I think the important thing to for anyone new to this concept is to remember that even during those periods where you're having losses, like your overall portfolio is, in theory, depending on the market and what index you're tracking, increasing. So it's your portfolio is building while you're also accruing these losses to help mitigate the taxes. So yeah, this is like a very good representation of exactly where that benefit comes in.
I like thinking of it as well as a credit card. Like, with a credit card, you're collecting points. Why not take the points, right? If you pay
Yeah,
in cash, you get the same product, but with a credit card, you're getting the product and the points. And then one day you can go and redeem the points, right?
exactly.
And so you can kind of collect them that way. Think
Yeah.
of tax loss as another sort of like asset in a way on the balance sheet. And then obviously the big question then becomes, and this, by the way, this is our thought process building the company. We're like, okay, yeah, this is great. So far, so good. But at what price? Like, am I paying a lot of money for this? Because then maybe it's not worth it, right? And unfortunately today, every single provider of direct indexing out there, that's especially the ones that are sold through an advisor. There's so many layers of fees that it stops making sense, right? And so to illustrate that, I have another chart. We want to first make an assumption that you harvest 40% of your investment in losses. And we saw the Vanguard chart. I think we can all believe this. And then the second one is you have cap gains outside to offset and save money. It makes the analysis easier. But it also works on the second use case. But this makes a nicer chart. And so imagine you've got $1 million portfolio, blended tax rate 30%, 10% annual return on the market, averaged out over 30 years. So what happens when you pay 75 bips to an advisor to do this, right? And this chart is basically, think of it as the difference between the ETF and the direct index. Like, should I be like how advantaged is the direct index relative to the ETF? So with the purple, you're paying 75 bips to tax loss harvest. You've harvested losses in the first 5 years, as we've shown right earlier. It's all front loaded, so most of the losses are in the first 5 years, and so you're at an advantage relative to the ETF. But then the losses plateau, right? And you're still stuck paying the 75 basis points, and that's the tax on your portfolio. That's like making you now grow slower than if you had bought the ETF in year one. And it kind of chips away at that portfolio until by year 12, you're basically right at the x-axis, basically exactly where you would have been if you had bought the ETF. No advantage, right? And so, as the fees come down, that line starts to extend. And I don't think it's just enough for the line to just extend out. Like for example, in the orange case with 23 bips, you're making a bit of money, but it's kind of not enough, right? And so you kind of want the money to be significant. So in our view, in our pricing at Frec, 10 basis points, paying a premium of 10 basis points against the ETF. Like if the ETF is 3, paying 13. If the ETF is 19, paying 29, that's very justifiable because you're going to have this compounding effect, right? That blue line also touches the x-axis, but in 150 years, you'd be dead by then. Doesn't matter, right? But the point is to extend that advantage, right? And so that's kind of the magic of low pricing is the tax savings and the alpha initially outweighs the premium that you pay, the cost that it takes to maintain and manage this collection of stocks. At Frec, we got a ton of people here, a ton of customers come to us who are tax loss harvesting, direct indexing at JPM with an advisor, at Fidelity with an advisor, at Parametric, and they're like, "Hey, I put in my portfolio 7 years ago. It's got like these embedded gains in it. It's ossified, whatever they call it. I'm still paying 90 bips. Can you do it for me at 10? Absolutely. You can bring your portfolio to Frac and it would plug and play into the system at 10 basis points, and it's way more maintainable. Um, and so that's kind of the number one thing
How,
about Frac.
Mo, I'm sorry, I'm gonna
Yeah, go for
just
it.
interrupt your question. How are you able to do it so much cheaper?
Yeah, good question. So there are like real nice economies of scale here. So because we have a direct to consumer model, right? As in customers work with us directly, we're able to sort of like do things that benefit from having more people on the platform. So just to put an example, if we're buying Apple for 50% of our customers on a day, right? Or selling Apple. Let's say we're selling Apple, right? Easier example. We can do one sell order to the street because we bunch and allocate these orders, right, at a certain time at the end of the day because it's cheapest to trade at the end of the day because of the bid ask spreads, right? So we sell at the end of the day, we do one trade to the street, and then the results come back in and we kind of allocate them to the customer accounts, right? So through technology, we're able to, instead of trading 500 times for the 500 customers, we traded once, right? So our costs are so low. There's really like it's a very nice high margin business.
Yeah,
There's not much in terms of cost there.
awesome.
Yeah, and then you have, the index licensing fees are minor. We have the crisp indices. So Vanguard, the popular indices of Vanguard, the VTI, VO, VV, etc. They all are based on CRSP, the crisp indices. And this
Right.
is an organization that is tied to the University of Chicago. And it's very cheap to license the indices. So they're fixed fees. They're not like AUM type fees.
Yeah, awesome. Very
Yeah.
cool. Thank you.
Okay. So some other kind of nice Frec features. So we have 16 indices now. There's like large cap value, large cap growth. There's VTI, like the total market cap, all the Russells. We've got some, sort of like ESG type indices. And so you can construct a whole portfolio of indices. You can set up an allocation is what we call. And you can say, well, I want to be, very popular one is like, I want to be, like VTI, is, 60%, and then maybe developed markets and emerging markets, 30%, and I want like maybe 10% in treasuries or something like that, right? So you can set up that kind of allocation. So any new deposit that comes in gets split in a way that makes sense, right? It gets allocated to help you reach the allocation, right? And you can rebalance as well on your own terms. There's no automatic rebalancing on your own terms once a year, once every 6 months. Rebalance, look at what the tax difference would be, and then we can do an intelligent rebalance for you. Um, and so that's kind of the allocations feature. And then we have self-managed stock. So you don't have to just use Fracta direct index. You can have also your other bulk self-managed account here. You can buy and sell. There's no fees with buying and selling, right? You can um, have your NVIDIA here or whatever else you have that's concentrated. Then you have a treasury account that earns you 4.12% on your cash. And then finally, you have a line of credit. So this is like one of those features that we love so much, but we don't talk about enough. You can borrow against your direct index and against your self-managed portfolio at a low rate, Fed plus 1%. And because we're deferring taxes, right? We love this feature because if you need to renovate your kitchen or bathroom or whatever else, and you have a temporary expense, maybe it makes sense to take a line of credit or a loan against your portfolio, take it out, do the work, then come back and pay it off, right? And obviously, borrowing on margin involves risk, so we have built tools to show you you're 49% away from getting a drop from in the stock market to get a margin call. And the margin call, by the way, if the stocks did drop, if your portfolio dropped 49%, you'd owe X in margin call, right? Way better than here's your margin requirement and your excess margin and having to like parse through that in your head. Um, okay. Brokerages, you can select a brokerage that's if you have your stocks elsewhere, they can come over to Frec with their cost basis. So it takes about 3 to 5 business days for that to happen. And then you can use those stocks to seed a direct index, right? So you don't need to fund with cash. You can also fund with a stock. Okay. And then these are common questions that we get all the time. So we group them and we're like, might as well go through them one by one to, knock them
I like
out.
that.
And then, yeah, if there's anything else not on this list, please let me know. But the first one is wash sales. So our platform, we manage wash sales. So we basically, if you have multiple indices with overlapping positions, or even within the index itself, we did a trade, we make sure that a wash sale does not occur, right? Because we don't want to, wash sales are not illegal, but they kind of claw back a loss that you harvested, and we don't want to do that, right? So we avoid wash sales for you. Now, we do have a setting that's called strategic wash sales. If you opt into it, you can harvest 16% more in losses, right? And so this is there's two types of wash sales: buy, sell, buy, sell, buy. So not to get overly technical, but we basically allow the types of wash sales that do not claw back losses, the buy, sell wash sales, and that gets you 16% of free additional tax losses that you can harvest on your portfolio, especially if you're doing regular recurring deposits on the portfolio, right? Okay, how much tracking error? So you can, and this is a paper by AQR, and we did the same research, and there's plenty of research on this. You can think of it as tracking error on average is 0%, right? On average, 0%, theoretically, right? But you do incur a maximum of plus or minus 1% per year. So you may be 1 year plus 0.5 celebrating, the next year you're like minus 0.3 and so on, but you're plus or minus a maximum of 1% a year, right, with a 95% confidence. And then you have an equal chance of being plus, and you do have minus tracking, right? And the tracking, obviously, it happens from these tax loss harvesting motions, right? You sell Tesla, you put it in some other basket of stocks. We use a very sophisticated risk model to tell us which stocks to buy. We use the MSCI bar risk model. It's very expensive, but it's very good. And so it has correlations in it, right? So we know that, for example, if you sold Tesla, these are the 7 stocks to buy that would move with Tesla over the next 30 days, right? Okay, and then you can also change um, tracking preferences. So you can the loss harvesting factor, if you will. You can say, well, I want to like track um, the index. I care a lot more about tracking the index than I do care about loss harvesting, or you can kind of do the opposite and we change the loss harvesting factor for you. Third question, will I be stuck with hundreds of stocks to manage when I'm done with this, right? And so I think the answer to this is kind of partially and like talked about it a bit in the feed chart. You don't need to exit if you're paying a reasonable price point for this. But if you do have to exit and you decided, I don't want to do this direct indexing thing for one reason or another, you can exit in a smart way. So the losses that you've harvested already, right? Let's say you harvested the 40%, right? You can use those losses to sell out the long tail of your index. And because these are all market cap weighted indices, right? The gains tend to accrue to the short tail. So most of the gains in an index, in a market cap weighted index, happen at the short tail, the top 20 names. And so the losses that you accrued, if you want to exit the strategy, don't sell these ones, right? And it's going to cost you a lot of these losses that you harvested. Sell the ones that are in the short, in the long tail, and then you'll have to manage maybe 20 of your biggest gainers, right? Not too bad. And so that's kind of a smart way to exit a direct index. Now, if you had used the losses, let's say you harvested losses, you used them to offset the sale of your house, and you're like, now I don't want to deal with a direct index. Well, there's no free lunch. You use the losses, so you have to stay. You know what I mean? But if you haven't used them, there's a nice way to exit, right? Um, And then finally, the tax forms, very easy. You get a 1099 form. There's got a consolidated summary, tax losses, short-term, long-term losses, gains, and that's what your accountant uses to, or your tax software, TurboTax uses to ingest into into your tax returns. And then just a couple of things. So we are a startup, and when we built the company, we realized that that might be an issue for people who are investing for the next 10, 20, 30 years. People may be concerned about, is this startup going to be around? We're doing very well. We're growing on average about 3% a week. We went from zero to 260 million in assets within the past year and a half. Where, knock on wood, it's even throughout this pullback, we've been doing very well because people uh, realize that more of the value during the pullback because we're harvesting losses. But anyway, so we actually custody the assets with Apex Clearing. It's a partner, custodian partner. Think of them as a partner, maybe for housing your stock, right? And you have your own login at Apex. You can log into Apex and see your stocks there, right? And they're the custody partner. They have 165 billion in assets on their platform. They're used by large other fintechs, Betterment, Ally, SoFi. Robinhood used to be with them, and they outgrew them. Wealthfront as well, and so um, we're kind of happy with this arrangement. So we're removed from the picture. We're going to be around. We're confident we're doing very well, but we also are happy that another partner who's has decades of history can is the custodian of assets. And then we have a very solid team. A lot of our engineers came from Google and my ex-colleagues at Twitter and they're a very strong security background. So strong trading oversight. Been doing this for almost 2 years now. Um, And then, yeah, just a quick nudge on what's happening next for us. Long short, we're very excited about long short. It's if you need the losses, and it's like September, right? And you have 4 months left to harvest losses. Then putting it in the long only index will only harvest losses for a few months, maybe not enough to move the needle. That's when you go for a long short index. You go for a 250, 150, 130, 30. There's going to be three flavors of it. So you choose one of them. They're going to be more expensive because there's financing fees, but it'll be worth it if you have the gains to offset. right? And then the other big project is a crypto direct index where we buy the coins for you with a partner, Anchorage, Coinbase, etc. And then we can buy and sell Bitcoin, for, Ethereum. Maybe we'll just do the top three or four coins and harvest losses by doing the same thing we do for equities, but without that 30-day wash sale window, because you can sell and buy Bitcoin right away and harvest losses that way. And it's really meant for folks who are, buying the Bitcoin ETFs, IBIT and stuff like that as a replacement. Okay, just I guess the last thing is some people ask us like, how do you get started? Like, should I sell my ETFs and put it in this instead? And in most cases, I guess as if 2 months ago, it was almost always no, because we were trading at all-time highs. Like, your ETF is at a gain. You don't want to sell it, pay a tax bill to that's the opposite of tax deferral. That's tax acceleration, right? We don't do that. And so, but if you have an ETF that's trading at a loss, you should now, especially now that, we're 10% uh, year-to-date loss in the market, something maybe you bought a lot 6 months ago or something like that, you can sell that ETF, book that loss, and put that same money into an equivalent direct index. If you have, we probably have the same index, right? If it's a large cap US, all cap, etc., it's on Frec. So you can sell and buy right away the direct index, book the loss, and then harvest losses in the future, right? And then if you have money that's getting invested anyways, inflows to ETFs, consider kind of like putting that same money into a direct index instead. That's all I had really. Thank you for your patience and for listening. And kind of sort of like going through all the materials. But happy to take any questions.
Yeah, no, thank you, Mo. That was a fantastic just review of direct indexing and the advantages and strategies to use that, and also kind of how you guys have built that into a seamless platform. So no, really really cool stuff. If anybody has questions, feel free, just you can unmute yourself and ask Mo directly, or if you want to put it into the chat and I can ask for you. um, Oh, yeah, here we go. Ricky has a good question. You mentioned ossification. Is that the same as getting locked in? How do you avoid that?
Yeah. So yeah. But what I meant with that is when you are direct indexing, what happens is you're harvesting losses, right? But when you harvest losses, you're pushing your cost basis down, right? Let's say Tesla dips 10%. You sell it to book the loss and you buy it back basically 30 days later, and then it kind of goes up from there, right? And so now you've locked yourself into a lower cost basis. And so constantly with direct indexing, you're pushing your cost basis down and taking the tax losses out, right? And so a lot of customers come to us with portfolios of direct indices that have had a lot of tax loss harvesting happening, and their cost basis is very low, and selling them would be expensive, right? And so there's strategies around that. Like for example, you could, if you're donating to a donor advised fund, you can always be smart about which lots to donate. You want to donate the lots that have the lowest cost basis possible, right? And then donate those. But there's really no like there's no real lock-in to direct indexing. It's just an account with stocks. You can always move the stocks around. The only, I guess, catch is if you move it around, you want to manage it. You don't want to just let it be, right? And so if you have 500 stocks um, to manage, that's not very easy, right? So you kind of want to have a plan around that.
Makes a lot of sense. I know we talked a little bit, especially as you got into the long short indexing or harvesting. Like timeline wise, if someone's, because there's going to be physicians of different career stages, and especially you brought up the example of selling your practice. And so as someone who maybe is towards the end of their career, let's say they're going, well, did I just miss the boat on this completely, or is there still something I can do? I plan to sell my practice in a year. Who knows what the market's going to do? How would you kind of talk to them about this opportunity?
Yeah, well, if you think you're going to have a capital gain tax bill, you want to plan for that, right? Let's say in 3 years from now, you think you're going to have some $1 million cap gain, right? And then you're going to have to pay taxes on it. It's going to cost you, I don't know, depending on your state and your income, maybe three, 400,000 in California, $500,000. It's going to cost, right, to sell. And so you want to say, okay, well, how do I get $1 million in losses such that I can such that I can offset that $1 million in gains? And so if I have a year left, like maybe I should go with a 250, 150 product because if I put in an investment into a 250, 150, it's going to generate in the first year alone 76% of that investment back in losses. Right? Obviously, now you have to put in like quite a bit more, like 1.5
Right.
million to get a million
Yeah.
back. Um, but if you have 3 years, then maybe you can be okay with a 130/30 or like even a long only direct index, and have it harvest losses for that event in the future with cap gains.
Okay. Fantastic. Um, a little bit of a separate. Do you, a lot of, like I said, a lot of physicians, myself included, are on kind of side entrepreneurial journeys and stuff like that. You've obviously, I mean, you've been incredibly successful in that stuff. What advice do you give to entrepreneurs, kind of as they're getting started, or would you give to physician entrepreneurs?
Yeah, it depends on the goal. I think if you're trying to build a company that is ambitious, then it's very sort of like it's then you need to pick the right market and do all the right things and build a great team, and there's a whole body of advice around that. But if you're trying to maintain your career path as a physician and doing something on the side, I think that's a whole different framework. And it's to me as someone who builds companies full time, it's it's kind of hard to juggle both those two things at the same time. My mind doesn't work that way, so I'm not the best person to to give advice on that. But I have plenty of friends who kind of do that, and it's amazing, right? You have kind of the stability of the full-time career, and then also the upside in the alpha, if you will, in the side gig. But unfortunately, I don't think I'm the right person to give advice in that area. But if you want to talk about like how do I like build an actual company, I have a lot to say about that.
No, that's awesome. I think just even through all this picked up a lot.
Yeah.
Um, well, see, any last second questions you want to get in? Now's the time as we're kind of hitting our mark. But no, I want to say thank you again for joining us and sharing your journey and what you've built, as well as the awesome advantages. What would be so someone who wants to just jump in and get started, what are their next steps? Go to frec.com.
So yeah, you could go to frec.com, but I think, given this is sort of like a small specialized group, what we can do as well is we can set you up with an individual on our team to like answer questions. You can have one-on-one time with them. We can create like yeah, thanks Amberly for posting that. You can set up a demo and then they can help you open the account, strategize like which index should I do. If you have a direct index already, like help you move it, answer any questions. And so you get sort of like the white glove service with us.
Awesome.
So please, use that demo link if you want to set it up, and or email me. You can email me as well if you have questions. Here, I'm going to drop in my email address, and yeah, I'm always responsive. So, yeah, but all you can do the whole thing yourself online by going to frec.com and signing up.
Awesome. Thank you so much. And I'll make sure when I send out the replay later tonight that I'll include those resources. So thank you guys so much, everyone who joined. Thank you, Mo, for taking some time out and sharing this with us. I hope everyone has a good night, and I'll see you on the next one.
Awesome. Thank you so much. Really appreciate it.
Bye,
Bye.
everyone.